Today, we're going to look at acquisition financing that works now. To do this, we're going to unlock the power of seller and mezzanine financing. Here's what you're going to learn from this webinar today. Number one, there are current economic conditions, factors that are impairing business acquisitions right now. You're going to learn what they are and how they're operating, why deals don't get done, how to know your deal can get funded from the start. Number three, you're going to learn deal size and why it matters, how lenders think and what factors are driving their decisions. You're going to learn about acquisition criteria, how to screen your target company for optimum success. You're going to learn about seller financing, how to ask for it and get it. And you're going to learn about mezzanine financing, how to qualify and use it to pull cash for yourself out of the closing. These are exciting times, folks, and the things that we're going to cover today are going to give you the knowledge that you need to go out and really excel in this particular period of the acquisition marketplace and timing. By way of introduction, timing is everything. In a world where financial landscapes shift every couple of years, the value of Bizar financing shines through. It's all about deploying the right strategy, methods, techniques, and tools for the times. Today, we find ourselves in a challenging environment. Interest rates have soared. Capital is restricted. Securing a business sale is tougher than ever. Baby boomer owners are eager to sell, yet few buyers or brokers have the savvy to structure compelling deals in this marketplace. Moreover, those who do often lack the efficient tools needed. However, amidst these challenges lie golden opportunities. High cash flow businesses are hitting the market at bargain prices, ripe for the picking. The keys to snapping up these lucrative deals lie in your Bizar financing knowledge alongside powerful tools like the business price calculator and the doable deal analyzer. Today, we're going to delve into the optimal financing options currently available, explore how to qualify for them, and demonstrate how they can not only facilitate the acquisition of a company, but also potentially put cash in your pocket at closing. Let's unlock these opportunities together and build your empire with precision and foresight. First, let's talk a little bit about why deals don't get done or aren't getting done right now. As interest rates climb, the cost of borrowing capital escalates, which in turn depresses business valuation. Sellers are finding it very difficult to get the kind of multiple that they want of EBITDA for their business. And EBITDA is commonly used to gauge a business's value. When that drops, making it difficult to achieve the desired sale price. So you got sellers that can't get their price for the business. Simultaneously, restricted access to capital means buyers struggle to secure the necessary funding, even at these reduced valuations. Big problem out there. People can't find the capital to make the business purchase. This financial squeeze hinders their ability to finalize acquisitions, leaving many deals unrealized. We see this every day out there. Great companies not getting bought. Deal size and why it matters. You've heard me talk about this before. The bigger the deal, the easier it's going to be to get done. It's never been more true than it is right now. Completing a business acquisition is not just labor intensive. It demands the expertise of highly specialized professionals. Attorneys, CPAs, inspectors, appraisers, tax specialists, and deal structuring experts, loan officers are essential for accurately valuing a business, structuring the deal, conducting due diligence, negotiating terms, and drafting agreements. It's a very intensive, expensive process. The involvement of these professionals make small deals disproportionately expensive and often unfeasible for lenders. I mean, just think about it. It doesn't cost a lot more to do a $10 million deal than it does to do a $2 million deal. The deal costs are all very similar, maybe a little more expensive, but not that much. So if you're going to expend it, think about it. Wouldn't you rather gear your time to working on the bigger deal if you're a lender than working on the smaller deal when you can make so much more money on the bigger deal than you can on the smaller deal? Same effort or very similar effort. The costs associated with completing a deal does not scale linearly with the transaction size. So as the deal size goes up, the costs don't go up proportionately. Consequently, lenders impose minimum thresholds, which guide our criteria that I'm going to share with you today for screening potential target companies. Let's talk a little bit about our deal criteria. This is the criteria we are going to recommend you shoot for. And I don't want anybody to get scared by the number. You can handle it. You're a Bizar financing member. You had the knowledge and the training available to you. So to meet the lender's criteria and ensure a deal is fundable, consider these factors. EBITDA. This is all part of the criteria now. You might want to make a note or two. EBITDA. Positive EBITDA. It's essential. Target entity should have an EBITDA greater than 5 million. Well, wait a minute, Gordon. That's a pretty good sized company. Yeah, it is. And that's why it's going to be attractive to everybody out there that you're going to want to interact with, because they're all going to have an opportunity to make a lot of money, and they're going to be highly motivated to work with you. And you have the knowledge and you have the tools to handle deals of that size. So positive EBITDA. Don't go after companies that are breaking even. Don't go after companies that are losing money. Don't go after companies that are small. Don't go after companies that aren't making substantial profits. Now, immediately that puts you in a whole new league. Okay? Puts you in a whole new league. Now you're going to make some money, and you're going to have plenty of powerful partners to help you. Number 2 on the criteria, revenue threshold. We look for companies with revenues exceeding $20 million. Well, wait a minute, Gordon. I've never even worked for a $20 million company. Never mind, I'm going to buy one. Well, you need to get over that, because this is where the action is. This is where the profits are. This is where all of the motivations are going to be in the right direction. So expunge from your mind that you've looked at all these small companies and you were worried even then how you're going to raise the capital to do it. Expunge all that from your mind. Get focused on the fact that this is the minimum size company you want to go after. Next part of the deal criteria, valuation range. At acquisition, aim for a valuation between 4 to 8 times EBITDA to facilitate value creation through potential synergies. All right, what does that mean? Okay, I would, for me, expunge the 4 to 8 times EBITDA. I would be looking for companies at 2.7 times EBITDA, on up to 3.5 times EBITDA. And anything over that, I wouldn't chase it, because you know what? There are going to be companies out there that are available to you that are in this range, and they're in the 2.7 to 3.5 times EBITDA. So they're going to be able to be bought where the financing for you is going to work really well. Number 4, market position. Focus on companies in fragmented markets, avoiding early stage, sometimes called greenfield opportunities, which are typically pursued in later acquisition phases. So if you're in your first acquisition, this is not what you want to go after. You want to go after the companies that are in a fragmented marketplace, but making good money. Okay. And they're relatively far along, that they've got a good growth history. 5, financial health. Ideal targets should have a clean balance sheet with minimal debt encumbrances. Okay, you don't want to go after messy companies that are hard to evaluate, hard to understand, hard to figure out where their money comes from, not clear where the money is being expensed. You want good, clean balance sheets and P&Ls so that you have a company that you can easily present and present favorably to a lender. And the 6th element of the deal criteria is growth stability. A track record of consistent year-over-year growth is highly valuable. The bank or the lenders are going to love that. Okay, so what we just painted for you is a picture of a desirable company. It's a company you should want to own. It's a company you'd be proud to own. It's a company you'd be ecstatic about owning. And every lender you go to, every investor you went to, anybody that you want to bring into this deal is going to beat down your door to get in on it. Okay, that's what you're looking for. And you're going to bypass all of the garbage, pardon my French. As you move along, you're going to find companies that don't look near this good, and you're going to just shine them on, even though maybe in the past that you would have said, hey, this is a good find for me. If they don't meet this criteria, they're not a good find for you. These are the companies you want to go after. Seller financing, asserting your position. Rather than asking, assert your terms. A lot of times people ask me, well, how do I ask for seller financing? How do I say to the seller, I want you to take a note for 80% of this transaction? And then you feel insecure in making that offer. Well, here's how you do that. Rather than asking, assert your terms. In the current market, substantial seller financing is often essential for closing the deal. Essential for closing the deal. And you're in a strong negotiating position, use it to your advantage. When presented with the seller's asking price and terms, respond confidently with a letter of intent proposing a purchase price between 2.7 and 3.5 times EBITDA, insisting no less than 70% be seller financing. That's going to be the terms of your LOI. You're going to present it to them just that way. Maybe you're going to ask for 80% seller financing. If this business is at the lower edge of our criteria, you might want to ask for 90% seller financing. It all depends on the situation. But I start out, absent a better reason, I start out at 70%, asking for that amount of seller financing. This bold approach signals to the seller, signals to the broker, serious intent and financial acumen. It's already going to say you know what you're about and you know what you're doing, because you know the marketplace that these businesses are for sale in. And don't listen to all this stuff. Well, we got 4 other bidders. We got 3 other bidders. We got all of this stuff. I don't listen to any of that, because if they've got 4 other bidders and they don't like my offer, then let the other 3 or 4 bidders have them. I look at a business like a bus. If I miss this one, there'll be another one along in 15 minutes. There are so many deals available out there for the terms that I'm talking to you about today that those are the ones that you're looking for. The seller's response will vary. They might ignore the offer, decline, or counter. It's almost rarely accepted, but those are the options. However, the current market conditions and your adept negotiation can place you in a favorable position. Most competitors of yours who maybe want to also buy this business will struggle to match your offer unless they have deep pockets. They're a big company. They got plenty of cash in the bank or connections to mezzanine financing sources. They got to have one or the other, or maybe even both. But you're going to have the ability to use the two tools we're talking about today, combining seller financing with mezzanine financing, that you're going to be able to knock the competition out most of the time. Now, another thing I want to identify here is mezzanine financing as cash at closing. A mezzanine loan has a unique property to it. The mezzanine lender is going to know how you're going to do this. They're going to know the structure. They're going to be a part of the purchase. Their money at close will be in the escrow. So as far as the seller, the broker, or anybody is concerned in relation to that business, including other lenders, are going to see that as cash coming into this business for the closing. So you don't have to worry about it like you do with a bank loan or an asset-based loan, where you have to first own the business in order to get the asset-based loan. The Mezz loan is financing to purchase the business. So it's cash that you come into escrow literally with. As far as the buyer is concerned, this is cash you're bringing into the business. Mezzanine financing is determined primarily by two factors. One, the viability of the business. Okay, I'm the mezzanine lender. What am I concerned about? If I'm going to get paid, I want to know I'm putting up money to help you buy a viable business. This business is a killer, man. This thing's going to go out there and knock everybody's socks off. And if you adhere to the criteria, guess what you have here? The viability business. You have it. Okay, number two is the equity within it. Okay, so if I'm a mezzanine lender, those are the two things I care about. This is a viable business and it's going to be able to pay back the loan to me. And the equity within it protects me. In other words, the equity is going to get lost before I take any loss. So I want to know there's enough equity in front of me that when my money comes in, I have some protection, because I'm not going to get personal guarantees. I'm not going to get liens on assets. I'm going to charge a little more money for my loan to make up for that risk. And I'm going to be willing to measure that risk and take that risk at some multiple of the equity that's already now in the business when this deal closes. All right. So just remember that. Okay. So following our outline criteria ensures that the business will meet the viability requirement. So you got that knocked by the company you selected. With strategic negotiation of the price and seller financing, you'll have adequate cash flow to service a well-structured mezzanine loan. So when you're all done and you're doing a pro forma going forward, you're going to be able to see how the cash flow of the company, based on the deal that you made with the seller and the deal you're making with the mezzanine lender, that cash flow is going to cover all of the debt service that's required on all the debt that you're taking on to do this company. Now, you can't do this, okay, if you're not buying the company between 2.7 and 3.5 times EBITDA, okay? You pay more for that for the company, the mathematics will start to break down. So that's why you're looking for companies in that sweet spot. The type of financing effectively fills the gap between the purchase price and the amount provided through seller financing. Okay, so that's the gap you got to fill. You got a $10 million purchase price. I'm just making that number up. You got a $10 million purchase price. You're going to do 70% seller financing. So now you've got 30% of the purchase price that you got to come up with. Well, it's the mezzanine loan that's going to fill that plus more, as you'll see in a moment, plus more, so that not only are you going to have cash to close this deal, but you're going to have working capital in the company to now grow it. And you're going to even be able to take some cash out and put it in your pocket at close. We'll get into that in a moment. Mezzanine lenders generally restrict the loan amounts to between 2.5 and 3.5 times the equity in the company. So that's their measuring rod, and that's one of the elements mathematically that you're going to be working with as you structure this deal. It's important to note that in our structure, equity is calculated from the balance sheet, including only the seller's note as a deduction. So when they look at the balance sheet of the company, it's got a net worth. Right? It's got a net worth in there, okay? But now you owe the seller a lot of money. But the only thing they're going to deduct from that net worth, and it's not even a full deduction because they actually treat it a little differently, is what you owe the seller. So you want to keep what you owe the seller as low as possible. But wait a minute, you want them to finance 70 to 80% of the deal. Well, that's possible. You can do that because all of that seller financing doesn't have to be in the form of a note to the seller. It can be in the form of what's called a rollback of what the seller receives back into the company as an investment. So at the end, the seller's financing 70 or 80% of the company, but maybe only of this $10 million purchase, maybe only $2 million is in the form of the note, and the other is in the form of a rollback investment of the money back into the company, which now shows us equity on the balance sheet. The seller rollback is not a charge against equity, but it is actually an equity reinvestment into the company. So the way you structure the deal is going to show plenty of equity on the balance sheet. Moreover, the buyer under this arrangement isn't investing their own capital to assemble the deal. Now, you're going to maybe incur some out-of-pocket expenses. You got some things you got to pay for, but, Bizar financing training, how to defer the payments to the attorney, the accountant, whoever it is that you got to have on your team. There are ways that you minimize all that. Really good business buyers don't get caught up in a lot of these personal expenses in putting the deal together. Yes, there are some. And yeah, they could run $20,000 to $40,000 to $50,000 out of pocket. They could. If you don't have that, you got to get a partner who, when you show them the whole deal and how you're going to assemble it and what you're going to do, can't wait to put $50,000 in your hands, because the piece of the deal they'll get is going to be well worth it. You got to be entrepreneurially innovative. Okay. You can't stop innovating. You got to keep thinking creatively. Instead, the financial structure allows them to facilitate the transaction without direct monetary contribution. So without your direct monetary contribution, you can assemble this whole thing. It's all done with know-how and a little bit of guts. You got to get out there and pull the trigger and do it. And just presume that you're going to be able to figure it all out as each thing comes to you. And if you can't, you call us here, right? Because we'll help walk you through some of that stuff to help you get through it. Okay. Mezzanine financing is cash at closing properly executed. This setup not only funds the acquisition, but also potentially releases excess funds after the closing. Remember the limiters, right? They're going to loan you 2.5 to 3.5 times the amount of equity in the company, which we just showed you how to make it considerable with the rollback from the seller. Now you got considerable equity in the company. So you're going to be able, under this structure, to borrow more than you need to close the deal. Okay, more than you need. The only limiting factor is that money from the mezzanine lender is going to be expensive. It's going to be very expensive money. So you don't want to borrow any more of it than you really have to, because that all has to be paid back. And the stress of paying that back is easy if you don't borrow out the full leverage potential. These funds can provide working capital for the business, a personal cash payout, often termed as a structuring fee or a success fee. When I close deals, we have National Diversified charge a structuring fee to the deal, and it gets paid right out of the close of escrow. Or it'll be called some kind of a success fee. It's paid right out of the close of escrow. So every deal we do here, there's a payback in cash over and above what it took to put the deal together. Remember, mezzanine lenders look only to the company to justify the loan. There's no personal guarantee involved, none. You go to the bank, what do they want? Personal guarantee, okay? Now their money's cheaper, but I'll pay the extra just not to have a personal guarantee, never mind anything else. This approach strategically positions you to capitalize on the acquisition with minimal personal financial exposure. All right, a little bit of summary and conclusion here. Today, we've explored powerful strategies that can transform the landscape of business acquisitions by mastering the intricacies of seller and mezzanine financing. You are now equipped to navigate the complex financial challenges of today's market. We've uncovered how to leverage seller financing to structure deals that minimize personal investment, and how to utilize mezzanine loans to not only bridge funding gaps, but also extract cash at the closing. Remember, the key to successful acquisition lies in the strategic application of these financing methods that allow you to capitalize on opportunities and expand your business empire with minimal risk and maximum potential for profit. Armed with this knowledge, you are well on your way to becoming a savvy acquirer who can thrive in any economic climate. I encourage you to take these insights, apply them to your acquisition strategies, and watch as your ventures grow. All right. Any questions? You got to have some questions. I know everybody knows a little bit about seller financing. We went through how you ask for it. You don't, no matter what the seller's asking for, no matter what their purchase price, no matter what their terms are, your offer is going to be the amount between the 2.7 to 3.5 times EBITDA, depending on the kind of business it is. And you're going to get adept after a while at understanding which businesses should be at the 2.5 end and which businesses should be at the 3.5 end. And I'll help you out there. If the business is growing rather rapidly, they're going to be more to the 3.5 side. If the business is stable, it's going to be more to the 2.7 side. If the business is losing money, you're out of that equation immediately, right? So you're not even going there. The growth rate determines the business. The reason stability doesn't matter is the reason you're willing to pay the higher multiple of EBITDA for the fast growing business is your purchase price is then fixed at that amount. And then as the business grows, it gets easier and easier to meet the payments on your debt service. So if a business is a rapidly growing business, you can pay more for it because you're going to grow into your ability to pay down that debt service easier because the business is growing fast. So you can afford to give a little more purchase price for that. So that's what brings you to the higher end of the EBITDA. So that's basically that. I can tell you your mezzanine loan is probably in today's marketplace going to cost you around 16 to 18%. And the lender will probably want some kind of an equity kicker on the loan or a bonus payback at the end. So that's going to be expensive money. And therefore, you want to keep that loan as small as you can. But if you went for the criteria that I shared with you earlier, you're not going to have any problem meeting that. So you are going to be one of the few people who show up to a closing table with all of the financing in your hip pocket ready to do this deal. And that's why you're going to come out ahead on these, unless the company you're competing against really wants it badly and has very deep pockets of its own, doesn't have to pay that high cost for its money. But any business today that's buying another company is going to have high cost of capital to buy that business. So you're not alone because you're an independent buyer. Your costs using Mezz loans will be a little higher, but it's all right. You're going to build it all into the way you structured the deal. And in today's marketplace, there aren't enough people who understand today's financial world that you're really going to have a lot of competition out there. So you're going to be one of the few people who know how to handle this transaction. All right. So that's the trade-off between the seller financing and the mezzanine loan. The seller financing, the reason the seller has to do seller financing, if they want any kind of a decent price for their business, is too few buyers have any capital that they can part with at those costs to buy that company. Okay. So if for a seller to get a decent price for his business, they have to be willing to finance a good portion of that business. And if you know how to negotiate that and structure it, that transaction is not that hard right now to sell it to the seller. And if you look at your baby boomers, what age are they right now? Okay, what age? All right, well, a baby boomer is right now between the ages of 65 and 79, somewhere in there. So a lot of these boomers have already sold because they had to retire. They had health issues. They had old age issues. They were stumbling and they realized they can't continue to run their businesses anymore. They had to sell. And they are still in that place where they have to sell. About 45% of all the baby boom businesses that were or will be available for sale, 45% of them are still yet to be sold. So plenty of marketplace out there, but they're now getting pushed up against the wall because now you've got the vast majority of them to where their age is pressing on them. They may have lost a spouse and lost their interest in living. They might have illnesses that are age related. They may have died and now you're dealing with the estate. There's all kinds of reasons why these businesses have to get sold. And in today's marketplace, you have just been equipped with the right tools, the right set of knowledge to close those kinds of transactions. So with that unique knowledge, you do not go after the little guys. You do not go after the losers. You do not go after turnarounds. You do not go after anything that's got any negativity to it at all. You go after the ones that are large by normal standards. They're not the big guys, but they're certainly mid-level businesses that are earning a $5 million EBITDA, where the amount of money you're going to have to borrow from that mezzanine lender has got to be $5 million or more. It's got to be $5 million or more. Because if you go out and look for a Mezz loan that's under $5 million, you won't find anybody doing it. They don't even want to talk to you about that. So you've got to need $5 million or more. So that means you have to go after the bigger transactions because that's how you're going to get the right partners to work with. So all of that is like really, really essential. But now with those tools and with the tools that you have within Bizar Financing, like our doable deal analyzer, our business price calculator, all will help you to zero in on a valuation of that business and making sure that you're going to have, based on the financing options you're choosing, you can know what those costs are, the interest rates, et cetera. You can know what the equity kicker is going to be at the back and how that's going to translate into how much money you're going to have to buy that mezzanine lender out with it 4 or 5 or 6 years from now, because they're not going to want to sit with a not minority interest in your company. They're going to want to sell it back to you. And it's going to be valued based on what the business would be worth. And you see, all that goes into those tools that we have that with a little bit of learning, if you haven't done it already, we've got all the instructions there. The spreadsheets themselves are all self-documented. You hover your mouse over the cell. It tells you exactly where to get that information off of financial statements. So once you have the financial statements of the company, you've got all the data you need to fill out those 2 spreadsheets, those 2 worksheets. And you've got an amazing tool that tells you in real time what your deal is going to look like. And if you have to make any changes because it's not working out, you're looking at the cash flows and they're not strong enough, it'll identify for you what elements need to change in order for the deal to be sufficiently cash flow positive for you to close the deal and get it done. And if a seller gives you a counteroffer, you can put their counteroffer into those forms immediately. Know exactly how, that counteroffer, how your deal would work out. And if it doesn't work out, it will tell you what you need to come back with as a counteroffer to that seller in order to get a deal that will work out for you and will ultimately work out for the seller as well. So all of those things are there for you. You have access to them, and those should be very, very helpful to you. Now, I do see a question from Kenneth. Let me see here. How long do you use a mezzanine loan for? Great question. Great question. Well, let me tell you how a mezzanine loan generally works. They are the most flexible in terms that you will ever see in a loan. They generally will not go more than 5 years. They want to get money back in 5 years, but they'll structure the front end as flexibly as you need it for your cash flow to work, because they understand what you're doing. They understand that you're buying this business. Cash flow is critical, and they don't want to kill you on cash flow in the front because they want you healthy to pay off the end. All right. So they're on your team. They want the same thing you do. So I've had Mezz loans that we've done where there's no payments for 3 months, none. So that way, all the cash flow that's coming into the business for the first 3 months can recapture all my costs, can make sure that the working capital is accumulating, can do everything I need it to do. And then at the end of 3 months, they might charge me interest only for the next 3 months. And then after that next 3 months, now it's 6 months into the deal, they might charge me for the next 6 months a very small amount of amortization of the loan, not the full amortization to pay it off at the end of the 5 years. And they'll, in stages, keep charging me more and more as I'm growing the business and able to pay the increased payments. And whatever isn't paid by the end of the 5th year, that will culminate in the form of a balloon payment. But guess what? By then, my business, if I run it right, should be twice its size. My ability to refinance my business should be incredibly good because I've proven now I'm running it well. It's building, it's growing, it's profitable. All the things that I wanted to be able to demonstrate to lenders is all there. I've got a history. I've got a track record. My ability to refinance that and pay off the mezzanine loan is very, very high. So that's usually the way it works. And the Mezz lender will be very flexible with you because they want you to survive. They want you to flourish. They want their big, high interest cost and kicker to be paid off. And that's how they make their money. Okay. They take a risk, which is why they get that high return, but they'll work with you. That's the key. Next question here was mezzanine loans are short-term loans. Well, if you consider a 5-year loan short-term, and then maybe the short-term, I consider that an intermediate-term loan. Okay. It's not a long-term. It's not a 10, 20, 30-year loan, but it could be amortized as if it were. The only thing is now I got to do a refinance at the end of that period in order to pay off the balloon. Now, sometimes the Mezz company wants to be repaid 3 years. Sometimes it's 5 years. It's all negotiated and it's all based on the realities of the deal, but it's usually within that range. And the balloon payment is always one that you will be able to pay off by refinancing, absent something like COVID happening between the time you buy the company and the time the loan is due. But remember, you got no personal guarantee, so please don't forget that. Can you combine mezzanine loans with transactional lending? If you do the right mezzanine loan, you don't need transactional lending because they'll show up at the closing with the money. It'll be there in the escrow. So that will be enough to cover the cash portion of what's going to go to the seller and what's going to go into working capital in the company and what's going to go into your pocket at the time of the close. That's the beauty of these particular tools. So it's structured so that everybody really is going to win. Okay. Everybody's going to win. And at the end of the day, if you're the owner of a reasonably successful business, which this is, but you can't sell it because there's no buyers out there with the money. Now, let me give you another example here too. This is really important. If you had a $20 million company, right? Because we said minimum 20 million. So I'm going to say, let's say you do this with companies from 20 million to 50 million in value. There aren't any little guys who are even contemplating buying companies that big. Never mind have the money. They don't have the money and they don't even know how to do it if they had the money. Really big companies who have the money don't want to screw around with a $50 million company. It's too small for them. So you're in a marketplace where knowledge alone makes you king. Okay, knowledge alone makes you king. You will be one of the relatively few competent buyers out there once you understand these two financing tools. And it makes you very, very powerful. Is a mezzanine loan the same as a bridge loan? No. A bridge loan is one where you need $1 million to close the deal. Okay. You've got all the other financing, but you're short $1 million. All right. So you go to a bridge finance company. So a company that does bridge loans, banks do them. Their criteria is a little different than other lenders, perhaps. but they'll make you a bridge loan, okay, under certain circumstances. And the bridge loan says, we'll give you the $1 million, you close the deal, then everything else will be done, okay? Your asset-based loan kicks in, all the other loans kick in because they happen at the close, but the money's not there unless you bought the company. You have to buy the company for those loans to kick in. So what the bridge loan does is it says, here, pay everybody that you're going to have to pay to buy the business. Then borrow against the assets and do all the other things you're going to do. And then from that money, you're going to repay the bridge loan. So a bridge loan is a loan that gets paid off in a couple of weeks, okay? Because that's how long it takes you to finalize those transactions. If you use the double escrow technique, you don't call it a bridge loan, you call it a swing loan because the money all changes hands simultaneously. So it's a swing loan as opposed to a bridge loan. Bridge loan happens over a very short period of time. And it just gives you time to get in there, orchestrate the assets that you got now, and then refinance them and get the bridge loan paid back immediately. Mezz loan is considered permanent financing for this transaction. And it's going to get paid back years from now because you've built a company that's profitable enough and cash flows enough to be able to meet the terms of the mezzanine loan. So hopefully that answers your question. All right. I don't see any other questions up there, but that doesn't mean there aren't any. So come on, guys, dig down deep. What other questions do you have here? First of all, can I get a raise of hands of people who say, this was great. I understand this and I think I can use it. Can I just see a show of hands there? Let me see if who's listening to me today. I see 2. I see 3. I see 4. Ooh, 6. Wow. I'm getting excited. All right. I actually got some feedback here. This is really good. Okay. You can put your hands down now and thank you for the feedback. I really appreciate that. Please understand that every era of business acquisition is different. Okay. It's based on the realities of the marketplace, both economic, business, climate, all of those things weigh on it. What's true right now is sellers can't sell because buyers don't have the money. And even though they've got great businesses, if they're in this sweet spot of 20 to 50, 60 million, then you're big enough that the little guys can't buy and you're small enough that the big companies don't want those guys. That's just too small for them to be bothered with. Even though they're profitable, they're just too small. So that's your sweet spot. And with the tools that you just have right here, you got a seller that's compelled to sell and compelled to be flexible. He has no choice. Okay. And so now is your chance to leverage seller financing, then back that up with a mezzanine loan that's going to be expensive. But if you follow the criteria that we laid out for you, they're going to have the cash flow, they're going to have the profits to be able to pay it back within the price range that we're establishing. So if you find companies and maybe they're decent or good companies, but they don't meet the criteria that we laid out for you, you just got to smile and pass. And again, you look at every deal like this is a bust. If you miss this one, don't worry about it. There'll be another one along in 15 minutes. And don't be surprised if some of the companies that you put an offer in on through your LOI for 2.9 times EBITDA and seller financing of 70%, and they told you to take a hike or they just ignored you, only to find out that 2 months later, 3 months later, 6 months later, a year later, they're calling you back and saying, is your offer still good? Then you say, well, I don't know. I got to go look at the markets. And then you go back and you renegotiate it with them. But the chances are you haven't necessarily lost them. I can't tell you in the recent, I would say in the last year, how many companies didn't want to do a deal with us and actually told us, they said, well, sorry, we're going with another buyer. I hear that a lot. We're going with another buyer. And then 2 months later, sometimes 3 months later, they're calling back. Their deal didn't go through because when the buyer tried to pencil it all out, they didn't know what you know right now. Okay. And so they didn't know how to put it all together, how to structure the deal to basically make it work. So that's really important to have a sense of the fact that you don't worry about deals you don't get. They'll either come back to you or you'll find another one. That's just the way it is. And especially if you're open to the types of businesses you can buy, if you only can buy a specific type of business, that does narrow your choices down a lot. And the other thing I tell people is never fall in love with a deal until it's yesterday's news, until the deal is closed, because you never know what's going to happen right up to the last minute. All right, more questions here. Hi, Gordon. Could we approach a listed company in the same manner? Well, the answer is yes, you can. However, seller financing is going to be a little difficult to work out because you got all these public shareholders, but maybe you have some majority shareholders that you could work a similar deal with. And if the company is big and listed, then the chances are pretty good that there's a competitor out there or a strategically oriented company where it would be a strategic deal for them. They have the deep pockets and they would buy that deal out from under you. But the structure doesn't matter. They can be a listed company as long as they've got shareholders that you can negotiate with for a controlling interest in the company. That would be part of the key. One more here. Can you acquire a company with a mezzanine loan? Do you have to pay the loan off, or can you assume the mezzanine loan? Okay, so if you're buying a company that already has a mezzanine loan, obviously you're going to factor all that into the price and the cash you're going to put up and all that. But I've done a number of mezzanine loans, and I've never seen one yet that says if you sell the company, you got to pay off the loan. Never seen that yet. The lender is happy to get paid off on their terms. It's just part of the risk that they take when they do the deal.